Hi, this is Brad Levin. In this very brief video, I'm going to share with you some technical analysis that I've done for the S&P 500 index. I'm seeing three very important indicators that are suggesting to me a strong possibility that the market might have bottomed on Friday, and we could see a reversal from here. This is a chart of the S&P 500 going back over the last 3 years. There's a lot of information on here, but let me zoom in and show you a shorter term time frame. This is known as a candlestick chart, and each one of these rectangles, either green meaning up days or red meaning down days, tells us how the market is behaving from day to day. I just put a red arrow there reflecting the all-time high for the S&P 500 at 2872. We go through this correction, pulling us down about 11% for the S&P 500 to where we ended up on Friday. This last little candlestick here tells us a very important story. Each one of these candles, in fact, tells an important story. The longer the length of the body, the bigger the move from the open to the close, but also the lines extending from it, known as shadows, tell us something very important too. And after the market has made a big move like it has, and we see a small body candlestick like this, but with long shadows extending from it, this tells us that sellers pulled the market down significantly, but buyers worked hard to pull it back up. And at the end of this tug-of-war, the market closed just a little bit above where it opened for the day. That suggests a possible change in direction for the market when we see this kind of candlestick taking place. Also, when this happens on a day of high volume, that adds even more significance to it. So that's my first indication. Second one, we can see when we take a look at this from a longer term time frame. Now, how the market behaves from one day to the next is not as important as how is it behaving relative to its longer term time frames. We see here again the same green and red candles, but also transposed over this, we see these long lines flowing through it, this purple, blue, and orange. The purple is the 50-day moving average, the blue is the 100-day moving average, and the orange is the 200-day moving average. This helps us understand how the market is performing relative to these longer-term time frames. When it's above it, the market is strong and moving in the right direction, and when it starts to collapse below it, the trend is beginning to weaken. You'll notice that we've broken through both the 50-day and the 100-day moving average, but on Friday, the market bounced right off of the 200-day moving average to close here at 2619. The last time that happened was here in November of 2016, and previous to that, it was in June of 2016. In both of those cases, we can see that the market rebounded strongly from there. The last indicator I want to show you is this chart down at the bottom called the RSI, or Relative Strength Index. This traces the market's direction and rate of change or pace. Now, the critical levels on this chart are 70 and 30. When the indicator moves above the 70 level, that is a condition that traders refer to as the market being overbought. You might have heard that before. The market can't sustain its direction indefinitely, either up or down. So eventually, the momentum gives out and the market will reverse. When it crosses back below that level, that's an important change in direction. The same thing is true after the market has gotten oversold, but then moves back above 30. That also happened on Friday. The last couple times that happened are here on the chart at the beginning of 2016 and also midway through 2015, both of which turned out to be important rebound levels for the market. Now, there's no guarantees, but all of these indicators together suggest to me a very strong possibility of a rebound. And for those of you looking for an entry point, this looks like a good place for me. Thanks for taking the time to listen.